Welcome to the Dev Journal. I am Sloan. We are witnessing a monumental divide in the technology sector. On one side, massive corporations are spending $200 billion on infrastructure. On the other, a new movement prioritizes sub-second model adaptation and hyper-efficient retrieval. It is a race between massive scale and surgical precision. We will examine how Sakana artificial intelligence is streamlining model specialization using their new Document-to-LoRA adaptation methods. This approach could change how developers deploy intelligence. Plus, we look at the new bidirectional models from Perplexity based on QN3, designed to handle retrieval across the entire World Wide Web with unprecedented speed.
How does this efficiency play against the massive capital investment we see from Alphabet? I am Vance, and I want to know if these autonomous agents from Microsoft Research can actually navigate multi-horizon tasks without the massive overhead we usually expect. The engineering requirements for these autonomous systems are shifting faster than the hardware can even be installed.
The contrast between these two worlds defines our current era of innovation. We have to decide if we are building bigger factories or smarter tools. It is time to dive into the technical details and the financial stakes of this transition. We begin today with the breakthrough in model adaptation that is coming out of the laboratory at Sakana. Think about the massive hurdle of keeping an artificial intelligence up to date in a fast-moving enterprise environment. Because until now, fine-tuning a model on fresh documents took between 40 and 100 seconds of intensive processing. But Sakana has shattered that barrier by reducing the latency for document internalization to less than 1 second. This shift from minute-long waits to sub-second updates fundamentally changes how businesses deploy intelligence, since their Text-to-LoRA adaptation system provides a fourfold cost reduction compared to traditional three-shot in-context learning, which allows for massive scale without the heavy price tag associated with constant prompting of the model. We are seeing a move away from static models towards something much more fluid and reactive by using these hypernetworks to generate adapters in a single forward pass so that developers can inject specific knowledge instantly, creating a user experience where the machine learns your specific data the moment you provide it without any lag. I wonder if the engineering trade-offs of compressing all that information directly into the model parameters actually hold up under the pressure of complex datasets. So Vance, since you often look at the memory overhead of these large context windows, how do these tiny adapters compare to the traditional way we store data in memory?
The memory savings here are actually quite staggering when you look at the raw data, because usually, handling a context of 128,000 tokens requires over 12 gigabytes of memory just for the key value cache. Whereas Sakana manages to internalize that same information into parameters that take up less than 50 megabytes. This efficiency comes from a clever perceiver-style cross-attention architecture that maps variable activations into fixed-shape adapters, which impressed me most because it maintained near-perfect accuracy even when the sequence lengths reached 4 times the native context window of the model, representing a significant architectural achievement for the engineering team at Sakana. They even pushed this into cross-modal territory with surprising results by using activations from a vision language model to enable a text-only large language model to reach 75.03% accuracy on the ImageNet dataset, which suggests that these hypernetworks are incredibly versatile at translating different types of data into usable internal logic. While internalizing data into parameters solves the local memory problem, we still have to handle the massive scale of the open internet. So we need to move from how models adapt their internal parameters to how they efficiently retrieve external web-scale data, which is where Perplexity is focusing their efforts with their new bidirectional models based on QN3.
Perplexity is tackling the chaos of the open web with their new suite of embedding models based on the QN3 architecture. These bidirectional models are designed specifically for retrieval augmented generation, ensuring that the information retrieved from the internet is actually relevant to the user's intent rather than just matching keywords. The real magic lies in how these systems handle the messy, fragmented nature of web data, which often confuses standard search algorithms. By employing specialized variants for user queries and document chunks, they can reconstruct clean semantic signals from the noise, creating a much more reliable foundation for high-stakes enterprise search applications. This ability to scale to tens of millions of documents while maintaining accuracy is what makes the business model for modern search engines sustainable. Without these advancements in retrieval, the cost of processing and storing such vast amounts of information would be prohibitive for any startup trying to challenge the established search giants. I find it fascinating how they can truncate these high-dimensional vectors without losing their core meaning. So Vance, how does that matryoshka approach actually work when you are trying to squeeze every bit of performance out of a very high-throughput production environment right now?
That matryoshka representation learning is actually quite sophisticated because it allows developers to shorten the embeddings to fit their specific budget while maintaining high accuracy levels. It works alongside diffusion-based pretraining, which treats the embedding process as a way to denoise the data, effectively filtering out the garbage that usually plagues web-scale datasets. From an engineering perspective, the native support for integer 8 and binary quantization is the real heavy lifter here. By reducing the memory footprint by up to 32-fold, they have made it possible to store massive vector databases on much cheaper hardware, which is a massive win for infrastructure teams managing large-scale deployments. They even released a specialized 0.6 billion parameter variant that is laser-focused on low-latency performance. While smaller models often struggle with complex semantics, this specific architecture maintains a high level of alignment, making it ideal for those high-throughput environments, where every millisecond of processing time translates directly into operational costs. While optimizing the retrieval layer is essential for finding the right data, the next major challenge is building the agentic frameworks that can actually orchestrate these models over long execution horizons. This is where Microsoft Research is stepping in with their new work on autonomous artificial intelligence agents in multi-horizon task environments.
Current artificial intelligence agents are remarkably fragile when faced with multi-horizon task environments that span long periods. Microsoft Research found that in high-load scenarios, completion rates for these systems plummet from 16.7% to a dismal 8.7%. This highlights why we cannot yet trust autonomous systems with mission-critical business workflows. By shifting to artifact-based evaluation, they achieved 90% agreement with human labels, compared to only 40% for trace-based large language model judgment. This breakthrough gives leaders the confidence to finally move these experimental frameworks into production. It addresses the fundamental lack of reliability that has kept these agents confined to small-scale internal testing. We are looking at a future where tasks involve over 1,500 execution steps, so the engineering needs to be incredibly robust. Vance, when you look at how they are actually managing that level of complexity without the whole system collapsing under its own weight, what stands out as the primary technical fix?
The fundamental issue is that context growth follows an order of n pattern, which eventually causes memory interference and total performance collapse. To solve this, the framework uses hierarchical planning that breaks work down across monthly, daily, and per-cycle scales. This structure prevents the model from being overwhelmed by the sheer volume of data generated during execution. They also implemented adaptive summarization, which kicks in once the context window exceeds 4,000 tokens. While that sounds efficient, the complexity of compressing routine content while preserving tool calls verbatim is a massive engineering challenge. It ensures the agent maintains clarity, but it adds another layer of potential failure to an already delicate system architecture. What really caught my eye was the 3.5 times performance boost they achieved through experiential learning using Facebook artificial intelligence similarity search indexing. By storing and retrieving successful trajectories from past missions, the agent effectively gains a form of specialized intuition. This tiered memory architecture allows for much more reliable execution than simply relying on raw compute power. Managing these complex task dependencies requires using directed acyclic graphs to map out the execution path over hundreds of steps. By structuring long-term storage alongside working memory and semantic retrieval via Mem0, they have created a blueprint for agents that can actually finish what they start. It is a necessary evolution for truly autonomous systems. We need to shift from the software architecture to the massive financial engines and hardware spend making it all possible, starting with the latest outlook for the industry giant powering it all, NVIDIA. Their 21-day outlook and the upcoming keynote address at the developers conference signal that the hardware side of this equation is still accelerating. Looking at the raw financial telemetry, NVIDIA is projecting first quarter revenue of $78 billion, which completely eclipses the analyst consensus of $72.6 billion. This massive delta suggests that the demand for artificial intelligence infrastructure is not just steady, but is actually accelerating at an unprecedented rate across the globe. Their fourth quarter data center revenue hit a record $62.3 billion, representing a 75% year-over-year increase. When you combine that with a gross margin of 71.07%, you see a company that has effectively captured the entire value chain of the current compute supercycle. However, we have to look at the volatility inherent in a stock with a beta of 2.31. Despite generating $96.68 billion in free cash flow, that high beta means any deviation from the expected roadmap could trigger a massive price correction for investors who are currently overextended. While the numbers provide a clear picture of their dominance, the narrative side of this growth depends heavily on upcoming public events. Sloan, given these massive financial figures and the sheer scale of their cash reserves, how do you see the upcoming industry conferences shaping the broader market sentiment for the next few months?
The market is looking toward the Graphics Processing Unit Technology Conference, Keynote, on March 16th, as the defining moment for investor sentiment during the first half of the year, with an average price target sitting at $262.51. There is a clear expectation that their upcoming product roadmap will justify the current valuation. Investors are specifically watching for updates on the Vera Rubin architecture and the Blackwell Ultra product ramp to see if they can maintain this lead. If the company delivers on these technical promises during the March conferences, it will reinforce the belief that we are still in the early stages of this build-out. Achieving a net margin of 55.60% on $215.94 billion in trailing 12-month revenue is a feat rarely seen in hardware. This level of profitability gives them the luxury to aggressively invest in new architectures while their competitors are still trying to catch up. This massive hardware spend from NVIDIA is only half of the story, as the companies buying these chips are under intense pressure to show results. We need to look at how that massive capital expenditure is impacting the cloud giants who are their largest customers, starting with the latest outlook for Alphabet Incorporated. Alphabet is finally demonstrating that their massive investments are bearing fruit within the enterprise sector through Google Cloud. This division has seen a staggering 48% year-over-year revenue surge, which is anchored by a massive $240 billion backlog of future business. The reach of their consumer tools is equally impressive, with Gemini Artificial Intelligence now boasting 750 million monthly active users. This massive scale provides a unique feedback loop that signals a shift from experimental technology into a core component of the daily digital experience for everyone. Beyond their core business, there is a wealth of hidden value sitting on their balance sheet that the market might be overlooking. Their 14% stake in Anthropic and 7.4% ownership of SpaceX help justify a valuation that many analysts believe could reach $400. With a forward price-to-earnings ratio of 23.24, the stock looks relatively attractive compared to its peers. Vance, when you dig into the sheer volume of capital they are preparing to deploy, do you see this as a sustainable path for maintaining profit margins?
It is a staggering financial commitment that warrants a very close look at their long-term capital allocation strategy. Alphabet is planning to ramp up their capital expenditures to between $140 billion and $185 billion by the year 2026 for infrastructure. While they generated $73.27 billion in free cash flow, this projected spending will push their operational efficiency to the limit. We are talking about a spend that could dwarf their current cash generation, which raises serious questions about competing in this brutal compute race. Institutional investors seem deeply divided on this trajectory, as we see a clear split in recent filings between buyers and sellers. With a relative strength index of 39.66, the technicals suggest the market is still processing the impact of this heavy spending phase. The average price target of $376.86 reflects a cautious optimism, yet the execution risk remains high. We need to see if these outlays translate into sustained profitability, especially when you contrast Alphabet's momentum with the cash flow struggle seen at Amazon.
Amazon is currently in an incredibly high-pressure financial situation as it commits to a staggering $200 billion capital expenditure plan for artificial intelligence infrastructure through 2026, a move that has already caused their free cash flow to plummet to just $7.70 billion. This dramatic decline in liquid capital is directly tied to the $131.82 billion they poured into capital expenditures over the trailing 12 months, serving as a sobering reminder that the race for dominance in artificial intelligence requires a massive level of upfront investment. To find the necessary resources for this transition, the company has implemented 16,000 job cuts as part of a deep corporate restructuring that highlights the difficult human reality behind these high-stakes technology shifts, where traditional roles are being sacrificed to fund the next generation of computing. While they maintain a gross margin of 50.29%, their net margin is squeezed down to 10.83% by these massive fulfillment and infrastructure costs. So Vance, I wonder if they can realistically sustain this level of spending while competing against other giants.
Holding a net margin of 10.83% is a difficult challenge when you are trying to outspend rivals like Alphabet and Microsoft on expensive hardware, especially since the stock price has fallen 14.81% over the last month to $210. However, there is a silver lining in the cloud because Amazon Web Services revenue growth is accelerating to 24% year over year. And if Morgan Stanley is correct that this growth will exceed 30% by 2026, this aggressive spending might actually be a masterstroke. Their recent partnership to launch open artificial intelligence models on the Amazon Web Services Bedrock platform is a strategic move to drive immediate product demand. Even though the neutral relative strength index of 49.58 suggests the market is currently in a very long sideways weighting pattern. Ultimately, we are witnessing a high-stakes gamble where the company must balance the massive capital requirements of the cloud against the drive for software efficiency, a tension that will determine if they can navigate this cash flow crunch without losing their competitive edge in the broader market. Sakana artificial intelligence is proving that document-to-low-rank adaptation can happen in seconds rather than days, while Perplexity is pushing bidirectional models to handle web-scale retrieval augmented generation. These architectural breakthroughs suggest we do not always need the massive clusters or the massive capital expenditures currently defining the hardware landscape for the biggest players.
That technical shift highlights the massive divergence we are seeing between the companies spending $200 billion on infrastructure and the innovators focused on sub-second model adaptation. This tension between brute force compute and elegant architectural efficiency will likely define the next decade of software engineering as businesses decide where to place their biggest financial bets. As these two worlds collide, we will be here to track the winners and the technical trade-offs that follow. We hope these insights help you navigate your own development roadmaps and investment strategies in this market. Thank you for spending your time with us today on the Dev Journal, and we will see you tomorrow.